Hello and welcome to today's episode, the retirement system in Kenya explained, and we are going to talk about NSSF, pensions, and what are the options that you have. This video is part one of the five series of a complete retirement planning and pension training series for Kenya. And in this series, we are going to break down everything that you need to know and understand about securing your financial future. We shall start from the very basic of understanding how retirement system in Kenya is structured, and we shall then move forward and look at how to calculate how much money you actually need to retire. That will be in part two. And then in part three, we shall discuss how do you choose the right investment strategy for you in your retirement. And then we shall look at selecting personal and workplace pension plans, and even designing the retirement structures for professionals and organizations. So if you are serious about wanting to understand more about retirement planning and wanting to understand more about pensions and retiring with dignity, retiring with stability, and being financially independent, this series will walk you through a step-by-step process, and we start from the foundation and work our way upwards until we learn how to execute, to build a strategy and to execute. So in this part one, we are going to look at the retirement systems in Kenya, and shall look at NSSF, the pensions, and what other options do you have. I'll start by asking you a simple question. If you stopped working today in form of retirement, how long would your money last you? Maybe 1 month, maybe 2 months, maybe 2 years, 3 years, or so on. And the truth is that most Kenyans work for 30 to 40 years. Their active working period is between 30 to 40 years. But very few understand how retirement actually works in Kenya. And we make some assumption. We assume that somehow NSSF will take care of you. You assume that your children will support you in your old age, or you will figure it out later. But later normally comes faster than you think, before you even figure it out. So in this video, I want to break down the entire retirement systems in Kenya in simple terms. What shall we be looking at? We shall look at the following. Number one, how retirement works in Kenya. Number two, what NSSF Tier 1 and Tier 2 really means. Number three, the difference between public and private sector when it comes to matters retirement. How do they handle the retirement issues? Number four, we shall look at occupational pension schemes. And number five, individual pension plans. Number six, who regulates all this? Number seven, the last one, the biggest mistakes that most Kenyans make when it comes to retirement. I'll try as much as possible to make this interactive, not interactive per se, but in a manner that you understand each and every aspect of what you're going to discuss. And by the end of this video, you'll understand retirement systems better than 95% of the working professionals in Kenya. Let's start from the very foundation. Section 1. We have got 7 sections, so we are going to go through each and every section. So section 1, how retirement works in Kenya. And I want us to look at the bigger picture. Retirement in Kenya is not automatic wealth. People confuse by the fact that they are going to retire, or they have retired, they will become wealthy. That is wrong. Retirement depends on what you individually contributed during your working years. And under this, I want us to look at 3 main pillars of retirement in Kenya. 3, not 2. Pillar number 1, we have got mandatory savings through NSSF. Pillar number 2, we have got employer-sponsored pension schemes. And pillar number 3, we have personal retirement investments. Those are the 3 pillars. If you don't build from these 3 pillars, retirement becomes financially stressful in your retirement age. In Kenya, currently, the typical retirement age varies. 60 years for the public sector, 50 to 60 years for those who like to call it early retirement, though it can go down up to 40 or even sometimes 30. Then we have got 65 years in some private contracts. But the truth is that retirement age does not matter. We've made videos and people keep saying that retirement age is 60, not 65, as you keep saying, but it doesn't really matter whether it's 70, 60 or 50, it doesn't matter, because what matters at the end of the day is whether you have income to sustain you when salary stops. So let's break down the first pillar, NSSF. What is NSSF? Every employer in Kenya, every employed person in Kenya, every employee in Kenya is supposed to contribute to the National Social Security Fund. That is long form for NSSF. And what is NSSF? NSSF is the government managed retirement savings scheme. Under the NSSF Act, contributions are divided into two. We have got Tier 1 and Tier 2. Under Tier 1 is the basic mandatory contribution. And where does this money go? This money goes into centralized national fund, and it's compulsory for all employees. Let's look at Tier 2. In Tier 2, this portion can either be, number one, this money can go to NSSF, our Tier 1, or number two, it can be directed to an approved occupational pension scheme. So I repeat, Tier 1, the money goes into NSSF. And Tier 2, this money has got options. It can be taken to NSSF, or it can be directed to an approved occupational pension scheme. This is what most people don't know, that NSSF is not designed to fully sustain your retirement. People make the mistake thinking that NSSF will support you. NSSF is a basic safety net, just to cushion you during the time that you retire. It's not supposed to supplement everything, to carry all the burden on its shoulders. Even when you contribute consistently for the time that you'll be working, the payout that you'll get after you retire is often not enough to sustain your lifestyle. So if your retirement plan is NSSF will handle you, that is a dangerous assumption, and that is dangerous thinking. NSSF is foundation, but not a complete retirement plan for you once your retirement time comes. Section 3, occupational pension schemes. This is the second pillar. And when you talk about occupational pension schemes, these are retirement schemes or plans that are set up by employers for their particular employees. If you work for a bank, a large corporation, an NGO, or any governmental organization or institutions, chances are very high that you are in an occupational pension scheme. And here is how it works. You contribute a percentage of your salary. Your employer also contributes a particular percentage. And this money, your contribution plus your employer's contribution, is invested somewhere. This money grows over time. And at retirement, you can receive this money in two ways. Option number one, you can be given the lump sum. And option number two, you can be given monthly pension income. And this is usually more powerful than the NSSF alone. Why? Because reason number one, the employer matches your contribution. If you give 10% of your basic salary, the employer gives you 10%. If you give 15%, the employer gives you 15%. I tend to think that it is capped up to a particular level. Reason number two, investments are professionally managed. And reason number three, it compounds over decades. But not all companies offer this. Many SMEs only deduct NSSF for you. That means that millions of Kenya, as you are speaking right now, they only rely on NSSF, which is merely enough. It's not enough. Let's go to section 4 and look at individual pension plans. These are for employed, for self-employed and smart planners. Now, what if your employer's contribution is not enough? Now you have to go a step further and look at individual pension plans. So if you are self-employed, a business owner, a consultant, a freelancer, or someone working in an informal sector, and there are no structures provided by your employer, you must create your own retirement structure. And this is where individual pension plans come in. These are called individual retirement benefit schemes. You open one through an approved pension provider, and you keep contributing monthly or annually. This money that you contribute is invested in either banks, equities, or money market funds, or any other approved assets that have been established and put in place to invest your money. One major advantage is what we refer to as the tax benefits. In Kenya today, pension contributions reduce your taxable income up to a particular limit. That means one thing, that yes, you are saving your money for retirement, and at the same time, it reduces the taxes that you're supposed to pay. Because remember, there's what we call taxable income. So your tax is deducted from taxable income. So when your taxable income reduces, it means that the tax that you're supposed to pay from this taxable income also goes down. And this is one of the most misunderstood wealth tools or strategies that people can use in Kenya today. Section 5, who regulates all this? Let us explain RBA, the Retirement Benefits Authority. All pension schemes in Kenya are regulated by one body, Retirement Benefits Authority. Their work is divided into the following 5 functions. Function number 1, they protect your pensions savings. Function number 2, they license pension providers. Function number 3, they monitor fund managers who manage your money. Function number 4, they ensure compliance amongst all the funds, all the pension providers. Then number 5, they protect members from potential fraud. So when choosing a pension provider, always check that they are registered, they are approved, and they are certified by RBA, Retirement Benefits Authority. Never invest in a retirement scheme that is not fully regulated by the Retirement Benefits Authority. Let's go to section number 6. We're about to finish and look at the public and private sector retirement. Now, there's a very big difference between how the public sector handles retirement versus how the private sector handles retirement. There's a big difference. Let's look at the public sector. And under the public sector, the government employees may fall under 2 major categories. Category number 1 is what you call Public Service Superannuation Scheme, or PSSS, or PS cubed if you like it. Now, what is PSSS? The Public Service Superannuation Scheme is a mandatory defined contribution retirement benefit fund for the Kenyan government employees. It has been in operation since January 2021. What does it do? It requires that employees to contribute 7.5% of their basic salary, and the government contributes 15% of the same basic salary, and this money is aimed towards improving their retirement savings. So you give 7.5%, the government gives 15%. That is option number 1 under public. Option number 2, we have got other older defined benefit structures that have been put in place. So traditionally, public sector pensions were more predictable, but reforms over time, they have shifted these and structures over a long period of time. So that is public. Let's look at private sector. Private sector retirement depends heavily on, number 1, the company policy or the organizational policy. The company that you are working with or the institution that you are working with at that particular time when you are employed, what is its policy as it regards to retirement? Factor number 2, occupational pension availability. And then factor number 3, individual savings discipline. How disciplined are you to be saving towards your retirement? Private sector employees must therefore be very proactive when it comes to their retirement. Public sector employees often assume that my pension is guaranteed. They think like that. But private sector employees always assume the following, that I will figure it out later on in future. But that figuring it out later in future normally arrives very faster than you can imagine. So both these two assumptions are very dangerous and they are wrong, because you have to keep planning your retirement very early. You must understand your exact scheme and not just have assumptions on what you think you'll do when the right time comes. Section 7. What are some of the biggest retirement mistakes that people make? And let's have a candid and honest conversation. These are the common mistakes. Mistake number 1, starting too late. Most people start thinking about retirement at age 45 or 50, which is already late. But retirement planning should start at 20, 25, or even 30 years. Time is your biggest multiplier. Time is your biggest ally when it comes to investment and when it comes to retirement planning. Mistake number 2, relying only on NSSF. As we've said before, NSSF alone will not maintain your lifestyle. It will give you maybe 20-30% of what you need at the end of the month after you've retired. So you have to fill up the remaining portion with other sources of income just to make sure that you are afloat. Mistake number 3, depending on your children. This is emotional planning and not financial planning. And why? We say so because your children will be having their own responsibility and they might not always be showing up anytime you need help. Mistake number 4, not understanding inflation. Money today is not money tomorrow. The money that you have today is not the money with the same value when it comes tomorrow or 10 years to come. Retirement should last you between 20 to 30 years, but inflation quietly eats away the portion of the money that you have, so that when you have 2 million today, after 10 years, yes, you'll have 2 million, but the value of that money will significantly have reduced. Mistake number 5, the last one, withdrawing pensions early. When changing jobs, many people always withdraw their pension savings. That normally destroys long-term compounding of your money. And this is one of the biggest silent wealth killers. So as we finish this conversation, part 1, you understand something powerful, that retirement in Kenya is built on NSSF, which only gives you the foundation, occupational pension if it's available in your occupation, individual pension planning that you take a personal initiative, and then personal investment strategy. If you ignore retirement planning in your early years, in your 20, 30 years, retirement will ignore you in your older years. And so in the next part of this series, part 2, we will answer the most important question. How much money do you actually need to retire comfortably in Kenya? And we'll work with particular amounts of money. We won't do guesswork. We'll be looking at real numbers. We will do calculations that you can see, and we'll base this on the Kenyan context. And so if you're very serious about securing your future, make sure that you watch part 2, because it will open up your mind and open up your eyes. And so if you find this video helpful, share it with someone who is working today but not planning for their tomorrow, because retirement planning is not about age, it's about awareness. So I'll be seeing you in the next part 2. Bye bye for now, and thank you for watching.